Greetings. Welcome to another BankBeat conversation. My name is Tom Bengtson. I'm the publisher of BankBeat magazine, and I am delighted to have as my guest today Josh Kiefer of Country Club Bank. He's in the capital markets group. Josh, thanks for being with us.
Thanks for having me.
Yeah, and so I wanted to get together with Josh because he visits with a lot of bankers throughout the upper Midwest region, hears a lot of things about what's going on in the industry. And I also think that the Country Club Bank story in and of itself is pretty interesting. So why don't we start there a little bit? Why don't you just tell us a little bit about Country Club Bank?
Sure. It is, it's a unique story. I like to think we're one of a kind. The bank itself was started in, hopefully I get these dates right, 85 I believe is when our bank started. One branch, about 40 million in assets. A gentleman, Byron Thompson, came from UMB to start the bank with some other investors. And shortly thereafter started a capital markets group actually in a $40 million bank, which, you know, in today's day and age, you couldn't really do that. You fast forward to today, we're about $2.2 billion in assets. We're still privately held, family owned, family run. Lots of Byron's children still hold executive roles in the bank, including our CEO, Paul Thompson. And our capital markets group, which is who I'm with, has grown quite a bit as well. You know, I don't know the statistics. We're nationwide, not in, you know, all 50 states, but probably pretty close. We've been doing business since '85, and you know, we're a full-fledged bond department within a community bank, which that is in and of itself, to me, a unique characteristic that many in our industry can't offer.
Absolutely, and I think it's interesting that you have an office about a mile from the BankBeat World Headquarters. So that's in Eden Prairie, Minnesota, and I think it's interesting that you're based in Kansas City. You have somebody, you're serving Minnesota and surrounding states yourself. You must really believe in this part of the country as a market for these services that you offer.
Yes, so my wife and I both grew up in Burnsville, which is just south of here. I went to NDSU, go Bison, and after school, my wife, who I was dating, moved to Kansas City. She was hired with Hallmark, so she was believe it or not, a greeting card designer, which is not really a thing anymore, I guess, with technology. But so I followed her down there and did some interviews, found Country Club Bank actually through my wife's boss, and got hired there in 2005. So Country Club Bank is all I know.
Okay.
Next year will be my 20th year there.
I see.
And so, yeah, a lot of friends and generations that, you know, I'm a part of are on their third or fourth job, and I think to myself, you know, I'm lucky and blessed to have found such a good organization that does so many good things.
Right. And I know you as a real people person. You connect with folks. And of course, in your work, you're connecting with bankers all the time at either industry events or you call on bankers in their institutions. Just tell us a little bit about what you're hearing. Like, let's say based on the last 6 months of visits you've done to various banks, what are you hearing from bankers? What are some common concerns, or just what are you hearing?
So really, no real surprises. You know, everyone obviously is concerned about their investment portfolio. Rates went from 0 to 5% in a very short period of time, which blew up our unrealized losses. They're starting to correct themselves a little bit. Time obviously heals that, because a lot of the investments they made will mature and they can reprice or put into their loan portfolio. So that time in and of itself will help heal that. Obviously deposit costs. You know, you went from paying your customers $0 and your cost to fund your balance sheet next to nothing to now it's 4 or 5%. Everything new you're putting on your books is very expensive to fund whatever assets that you're funding, whether it be loans or bonds. Liquidity liquidity is obviously an issue, and hopefully when we get into interest rates, I'll bring liquidity up again, because I take a very basic approach when I help banks kind of develop an interest rate bias, I'd like to say, as opposed to a forecast. Economists are like meteorologists, right? Everyone has a lot of data to back what they're suggesting is going to happen, but it's 50-50. It's a flip of a coin on whether or not it's actually going to happen. So liquidity, bond portfolio, depreciation in value, and then finding loans. I think banks are still finding loans. I haven't really heard a ton. It's maybe slowed down some, but seems like they're still able to remain flat, if not growing a little bit.
Yeah. So talk a little bit more about that. Of course, banks have an investment portfolio, but then of course they have a loan portfolio. And what can you say about how a banker might think about those two components of their business and how they should work together, if they should at all?
So obviously, and this is something easy for me to say, working for a community bank, I know where our bread is buttered. And I know why we're in the business doing what we do, and that's to help the communities we serve. How do you help the communities you serve? We make loans. Making loans is absolutely, and it's hard to say this as a bond guy, but making loans is the number one thing we need to be doing as banks. The bond portfolio supplements the bank when the economy, when we're on an economic downturn. When we're on an economic downturn, you have less people coming in looking to borrow. And typically what happens in the quote-unquote banker's trap, when we have an economic cycle that's moving lower, you have fewer people coming in to borrow, and you have more liquidity because people are depositing their money in your bank for safety or whatever reason it may be. So oftentimes at the downside of a cycle, we banks are flush with liquidity, and we don't have the loans to fund that we would like, the amount of loans to fund that we would like. So then we typically look to the bond portfolio to supplement, as my second asset on our balance sheet. And when on the opposite flip side of that, where we are now, interest rates are, near their highs, which I like to think we are near our highs. That's just my opinion. And there's many reasons for that, whether it be the yield curve, whether it be looking at a regression of different treasury curves, or my favorite indicator, and I joke about this, but I call it the BSI. People in my office would laugh if they heard me say that, and it's called the bond sales indicator. What does that mean?
Yes, what is the bond sales indicator?
So this is what it means. I've been in this business long enough now to know. I've been through enough cycles now. I work exclusively with banks and their bond portfolios. I don't work with individuals or anything like that. So specifically with banks, in our industry, when our business starts to tail off and sales start moving lower or trending lower, that typically means you're at the top end of a cycle. And what that means for banks is they have less liquidity. So all the liquidity they have is going towards loans because we're at the top of an economic cycle. They have a lot of borrowers coming in. Now, when we don't have liquidity and not buying bonds and the bond sales are down, history would show, you can look back in any cycle. When that happens in our industry, sees sales tail off, that's typically the indication that we're near. I don't time the market. I don't know. I can't tell you exactly when or how much something's going to move, any magnitudes. But I can tell you, relatively speaking, we are near the top end of a cycle every time banks don't have the liquidity to invest.
Okay.
And when they do have tons of liquidity, think back to when rates were zero, banks were flush with liquidity, and they bought all these bonds that are now at incredibly depreciated price levels.
Right, right. You use the term, you don't try to time the market. Of course, at the retail level, we hear that all the time, don't try to time the market. Is that good advice on an institutional basis as well? Or maybe some people can time the market, I don't know.
If you're trying to time the market, you're probably going to lose every time.
Okay, I will take note of that.
That would be my guess, and I think that's what they say on the
Okay,
equity side
okay,
too. So, we always think the better approach is just having a general consensus, a general feel for where we are in the cycle. Mm-hmm. Are we near the top of the cycle? Are we near the bottom of the cycle? And there are many tools we use. There are many, there's tons of tools out there that people can use to get that bias or that feel for where we are in the interest rate cycle. And then we sit down in our AL committees, our investment committees, our loan committees, and then we start to make pricing decisions, how we're going to price our loans, how we're going to price our deposits, what we should be buying in the bond portfolio. We start basing those decisions off of that bias. Mm-hmm. Now, we obviously can hedge, right? We can, in my business, and you didn't ask this question, but I'll go into it, the barbell approach, when I do a lot of education. I speak at the graduate school, investment school, and I talk about the barbell approach a lot because in banking it's important because the portfolio is there for both cash flow and yield. Mm-hmm. Okay, so I'll oversimplify the barbell approach. Think of a barbell. You have the two heavy ends on either side. So what we're doing is we're investing in yield on one end. That's duration further out the curve. And then we're investing in cash flow on the short end, right? And that can be a number of different products you can choose to put on both sides of that barbell. But the reason we do that is because, again, we come up with a bias, and that bias might be, so let's say my bias today is for rates going lower. Well, again, it's a bias. I could be wrong, right? Mm-hmm. Rates could go higher.
Sure.
So if I take that barbell approach and don't put all my eggs in one basket, yield is good for a down rate environment. Cash flow is good for an up rate environment to reinvest. So as long as I fund both of those and maybe I manipulate how much I put in both of those as far as product selection, as long as I do that, I heard someone in our industry say, it's, as opposed to being all wrong, it's better to be 50% right. Right?
Okay,
so if
sure.
you do the barbell approach and you're incorrect,
okay.
Again, you can weight it towards the bias you have, but don't neglect the other side because if you're wrong, you want to have something there to pull from.
Sure. Now you've been at this, as you mentioned, almost for 20 years. Technology has played just an enormous role in almost every aspect of banking in the last 2 decades. How about in terms of what you do in the investment world? Has technology been important, and are there tools available today based on software or other kinds of technology that weren't 20 years ago?
Related directly to my business, it's hard to say. I mean, technology has been great for, using tools to help make better decisions. Mm-hmm. I would say that that's an important piece. As it relates to my business, we've always had Bloomberg, which has been a great tool for us in our industry to use. But as it relates to banks, there are a lot of great analytics that banks can use to help analyze their current positions in their portfolios, again, to make better decisions for what they think is going to happen in the future. AL reporting just continues to get more. I mean, you see reports these days and they're about as thick as the Bible. Mm-hmm. Now, ours is as well at Country Club that we built and provide to our customers, but most of it's supporting data, I would say it's made a great role in helping us make better decisions, I think would be the ultimate that technology's provided.
Sure. Well, how about as you do look back over the last 19, 20 years, what are some of the things that have changed or really stand out in your mind as a significant development in banking and then specifically in the investment side that you're active in?
the product. The product has changed entirely as it relates to bonds. And what I mean by that is, now this is well before my time. Bond portfolios anyone who watches this, who's been doing this longer than me, 30, 40 years, knows bond portfolios used to be treasuries. Plain and simple. Then agency bullets came in, and then callables, and now mortgage backs and CMOs and private labels and dust bonds. And, you know, I would say 90% of what exists today, 30 years ago, either didn't exist or banks didn't deal in. They kept it very plain vanilla with treasuries. You know, I joke today, in my 20-year career, I can probably count on 2 hands and maybe 2 feet how many times I deal in treasuries, because banks are so, we want spread. And with the safety that home loan and farm credit and Freddie Mac and Fannie Mae offer, which are the 4 primary agencies that we operate in, whether it's mortgage backs, debentures, and so forth, you know, typically the safety's still there, so banks are reaching for spread. And then munis, you know, that's obviously a whole nother ball game, and you know, we'll see what happens with tax rates, because that has a direct effect on municipals. But for sub-S banks, you know, municipals have, and if nothing changes from a tax standpoint, they will still be a very important piece to bank bond portfolios.
Okay, so as you think about how the product has changed, you think about what you're hearing from bankers as you talk to them. Let's say you look out the next 5-10 years in the industry. Are you generally optimistic about where you think the economy and therefore the banking industry is going, or do you see a lot of sort of black clouds that cause you concern?
I am not cautiously optimistic. I'm super optimistic.
Super optimistic. Okay, love that.
And here's why I'll say that. I know, I have an intimate knowledge of Country Club Bank. Not as much as I would, as our executive level does, but I have known our leadership. I have known numerous people within our bank. I actually started my career with Country Club for 2 years, where I spent time in each aspect of our bank, and we have a lot of different departments in our bank. So I was able to meet a lot of people, and you know, I take our bank because I know it well, and then I look at all of the people that I do business with or am associated with or meet in this industry, and we're all the same, and it's great. And you know, you talk to people, and rarely do I hear anyone say they've been with a bank any less than 15, 20 years. And that's astounding to me. Again, I go back, you look at my generation and younger generations today, and it's like they're there a year and they move for an extra $1,000. There's not quite as much loyalty as there is, and I think there's an even greater amount of loyalty in our industry, community banking specifically, that to me, I think it's the fabric of the economy, because that's who I think relationships mean more to people than they even know.
Yeah.
And I think that's very important.
And I agree with that as we go and more technology and more everything, relationships become more valuable, because they're harder and harder to find, harder and harder to maintain. And when you have a good relationship, it's really worth it to do everything you can to retain it, right?
Absolutely.
So anyway, well, this has been a lot of fun to visit. Our time is closing here, so we got to wrap this up. But Josh Kiefer, Senior Vice President at Country Club Bank, doing investment work with banks all over the Upper Midwest. Thank you for being here.
Thank you.
We're grateful to all of those of you out there watching this. Thank you so much. My name is Tom Bengtson. I'm publisher of BankBeat magazine, and this has been another BankBeat Conversation.